This is a very, very important session because we need to pull everything together so you can start getting your pitch books. We're getting close to the end of the semester. So we want to start scheduling the pitch book presentations the week before Thanksgiving, even into the week of Thanksgiving if we need to. So you get at least one done before Thanksgiving. Once you get one done, the next two will be easier and faster. So what you're doing right now is you're doing valuation, and then you're going to do the pitch book. I think I'll start with valuation and I'll show you what I do with Walmart, but just real quickly what I do with Walmart. I like what I see some of y'all doing with large language models. Notebook LM is one I need to use more often. If I were in your shoes, boy, I'd be using Notebook LM in all my classes. I love how it reads chapters and creates questions and quizzes you on the chapter, and it does a really good job. So here I use ChatGPT. I did a value chain management for Walmart, and did a SWOT analysis for Walmart. I think Nicholas talked about putting the annual report in the chat in Notebook LM and having it summarize what this business is and what's going on here. You could probably do that with an analyst report as well. But use AI. You want to use AI just so you can say you're using AI in an interview, right? That's pretty critical. Your professors don't like you using AI, but your employer certainly wants you to use it. Don't tell them you're copying and pasting it and sticking it in the PowerPoints, but that you're using it as a research tool. So I'll talk about what I learned from Walmart. So Walmart's the firm I'm going to value. So you start off with the financial analysis. So when I look at Walmart, very, very liquid firm. This is a firm that's probably one of the best in the business in managing its working capital. So I don't have an issue with that. I do want to ask, are they getting better or getting worse? And it's been pretty flat, not getting better, not getting worse, but they manage it so extremely well. Sometimes when you're the best in the business, you don't really need to get better. You just need to hold that position. They are sending quite a bit of money to their stockholders and bondholders. They've been doing that the last few years. Pretty sizable amounts of cash. They did borrow a lot of money to buy Flipkart a few years ago, but Flipkart, as far as I can tell, I would do some research on Walmart on Flipkart. I do think they finally have made some headways into India, and that's a big part of that. So liquidity is not an issue. They are seeing some increase investing in CapEx, which is pretty impressive, right? They've increased their CapEx and they're giving a lot of money to their stockholders, so that's pretty good. I'm not worried about their debt. Their times interest earned is very, very strong. Their debt levels have come back down. They're still below the industry. I'm not worried about debt. Plus, they're AA rated. I'm not that worried about a AA rated firm. So this is a firm that's going to be around for a while. So then it comes down to growth, which comes down to turnover and margins. Their revenue per square foot is in line with the industry. Not particularly weak, not particularly strong. Their revenue per employee, I don't care about. The revenue per PP, I don't care about. Revenue per store is actually doing better than industry. The thing I would have to check with Walmart that I haven't pulled the numbers. I want to look at their international business versus the US business. What I understand is their international business has higher revenue growth, but weaker margins. So I want to look at that and see that impact on margins. I understand that business. I would probably specifically look at India by itself, look at Europe as a group, look at South and Central America as a group, looking at what they're doing in those two areas and how much that impacts. Can I get the data by country? Probably not. I would love to see revenue and gross margins by country. If that were possible, that would be really, really helpful. So that's the kind of thing I would look at. So for Walmart, their international strategy is extremely important to me. So I would put some time there. How it's affecting these numbers would be important. I don't know, revenue per store, I'm assuming curbside and home delivery are being assigned to a store in revenue. That's not a separate revenue source. What bothers me about Walmart is with all the things they're doing overseas, their revenues are only growing about 4%. You think they're not adding that many stores here recently. They've actually been pretty flat on their store. Square feet have been pretty flat. But with all they're doing on the internet and overseas and all these other places, their revenues are just not that strong. So that gives me some concern. So I'll talk some more about what other options they have. Their asset turnover overall is in line with the industry. You would think they'd be pretty strong at asset turnover, so that's a little surprising. Their gross margins are in line with their industry. Their net margins are actually slightly better, but declining versus the industry. This is really, really key right here for you doing retail. When you're looking at net margins, firms with below average net margins should have much lower EV to sales. Firms with above average net margins should have higher EV to sales. That's going to be important for me because I'm going to use EV to sales when I'm doing my valuation of Walmart. So I need to know where are their margins. This is what bothers me so much about Costco. Costco has very, very low. Costco is down kind of in between the bottom and the median. They're very much below the industry, and yet they have very high EV to sales. That bothers me a lot when it comes to valuation. Return on equity, they're in line. You know, how often do I say Walmart's in line with their industry? They're very much in line with the industry throughout. So it comes down to valuation. But you look through this, which of these charts would I put into our paper? I would probably put a revenue per store and a gross margin and a net margin into my paper just to show where they're aligning on those most key factors. I might bring in an inventory turn factor into this model for Walmart. I think that's pretty important. I might show their working capital and just how strong they are on that it's a source of cash. But you just look through these charts. You're not going to use every single one of these charts in your pitch book. You can pick 2 or 3, 4 that really make the story of who this company is. Remember, in your pitch book, what you're trying to do after you give a short history and description of the company, you want to say what is distinctive about this company, what makes them different from everybody else. And if you're not giving that in your pitch book, you're really missing the point. And then what really excites you about this company? So don't talk about things that everybody does in this industry. You're talking about the stuff they do really strongly themselves. We'll talk about the SWOT. That's really important. I'll do that at the end. But your SWOT, you want to try to prove some of that, your strengths and weaknesses, especially with some charts. All right, so I got a good feel of the company. So I'm going to do a DCF valuation. I start with the discount rate. I have the risk-free rate and the market risk premium. Those are 2 numbers you're going to take to the Capital IQ model. So make sure you have those. Everybody knows that, right? Capital IQ needs that risk-free rate. Keep using these numbers consistently with all of your companies. And then I had the beta. Someone was asking me how many of these numbers can you change? You need to change all of them. So the first question is, what kind of company is this? Is this a cyclical or defensive company? Just ignore their debt, their operating leverage. So this is definitely a defensive company. The operating financial leverage, you get that by looking at those charts over here. Look at their margin volatility and their debt to equity and get a sense. Do you need to adjust their beta significantly? I know there's formulas for levered and unlevered beta. I'm not telling you have to use that in this class. I don't see them that much in practice. The main reason is beta is so unstable and it's somewhat subjective. People kind of pick one that I don't like huge precision on a number that we're going to end up going like this on. So I'm more of a theoretical how to adjust the beta, but if you want to use the actual formula, you certainly can. There are ways to definitely adjust financial leverage. I have not seen a formula for adjusting operating leverage to get a beta precisely. But think about the company. Is their operating leverage reducing their beta? Are they more stable than competitors? Are they less stable than competitors? Are their debt levels higher, lower? And then look at their history. On the history, you bring this data in using Bloomberg. The formulas are right here. So if you want to make the formulas values, you need to select. I'll take really detailed notes on this part. I'm going to give you some information on the files that you're really going to need. So once you get your data, make sure columns A, B, C, and E all the way down to the bottom. you copy and paste those as values. That's where the Bloomberg formulas are. You don't need to copy and paste anything to the right. Now, let's say target came in with some errors. Well, what that was. Well, I guess I didn't paste these as values, sorry. So let's say Walmart comes, let's say Target comes in without data until late into the game. So write this in your notes. Over in columns J, K, and L, if you see that you have some error messages over here, just find the section that has error messages in columns J, K, and L, and just hit your delete where you have the errors. And what will happen is you'll still get a line, but it might start right here. All right. So put this in your notes on the rolling beta. Sorry, I forgot to copy and paste these as values. Let me see if I can load this.
And that's just for deleting the error cell.
Yeah, let me show you. Don't delete the rows. Let me reload that one. It is nice that it doesn't. Let's see if I can copy and paste it before it shifts. All right, so you copy and paste columns A through E, so you have data. So let's say Target had some errors for a few years. So you see what it does to the graph. So all you have to do is go over in columns J, K, and L to the one that has the errors and just go down and find the errors and just highlight those that have the errors. And don't delete the rows, just hit the delete key. And when you do,
we delete the
huh?
What happens if we delete?
Well, you mess up the whole file. So yeah, don't delete rows. Just hit the delete key. All right. For some reason, it didn't change it, but anyway. But there it goes. So see, I had to hit the count. But see right there, what I did with Target is that bad data just went away. So I've seen some where there's only data for like the very, very end, but it's still useful information because it shows that the beta is real similar to the other companies for those few years that they had. All right. Everybody follow me on all of that? I talk really fast sometimes. Everybody's good? Some of y'all have a furlough browse. So bring in the data. One other thing I will mention, if you come down to the bottom, I did Walmart through August. So you may be missing the last 3 rows or something. You can, if you want to, just copy them down. So I'm not sure if the graph, I think the graph automatically adjusts for that. It goes through 489. Which is where I am here, but you might check the graph, make sure it's going through the full range, but that's your rolling beta. You probably won't put this rolling beta into your pitch book. So for beta, I don't see many pitch books that spend a lot of time talking about betas. So they're going to trust you that you have the right discount rate with your firm, but you still have to do the work as part of your due diligence. So that gives me a discount rate for Walmart. Once you put in all the blue numbers, then on the valuation side, it really comes down to growth. So I have historical growth. Be real careful on the growth. There's another thing on the Bloomberg data pool. On the growth rates, be real careful whether you have column R or Q. So remember these formulas. The 3-year growth rate is equal. You take your very, very last year and you divide it by what to get 3 years. You go back 3 years. Go back to 4, right? Because you have 3-year growth, 1 growth, 2 growth, 3 growth. So if you're going to do 3-year growth rate, you do the last column, you go back 4, you raise that to the what? 1 divided by 3 minus 1. All right, so there's that formula. The 3-year growth. Some of you have data through column Q, some of you have data through column R, depending on whether they have 2024 or 2025 data yet. All right. So 5-year, what would you do with 5-year? Well, exact same thing. You go find that very, very last column and go back 6. 1, 2, 3, 4, 5, 6. Raise that to the what? Divided by 5 minus 1. There's the 5-year growth. Some of y'all have errors here because you don't have anything in column R. So it just doesn't work. And then in 10 years, same thing. You just take the 10th year, divided by, go back 11 years. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 1 divided by 10 minus 1. So you'll either be starting in R or Q, dividing by H of G, and you just copy that down. So just be aware, you may have to make an adjustment on these growth rates. I like having 3, 5, 10 years. If you have a negative number, it won't work. So you can't have a CAGR off of a negative number. So if you have a negative number, you'll just get an error message. All right, so I've given you 3 places you got to adjust the model. 2 of them on the beta side, and then 1 here on the data pool, the Bloomberg data pool. Make sure you have those CAGRs. I'm assuming y'all are all good at CAGRs. We use them all the time in finance. In my career, I have no idea how many CAGRs I've done. It's somewhere in the millions, because I know I've had spreadsheets with 50,000 rows of data that I'm doing CAGRs all over the place. So it's pretty common. So it's ending value over beginning value raised to 1 to the number of growth periods minus 1. It's the formula we use all the time. What does CAGR stand for? Compounding annual growth rate, right? But there's certain things you just assume a finance person knows. And some finance students get through 4 years of school and they just never had a professor say that. It's not their fault. It just never came up, and it's just assumed you know it. That's one of those things. It's just assumed you know as a finance major. All right, so growth rates is the most important thing of all. It comes to valuations. So I've given you some historical growth rates. I've given you some ways to see what the market thinks the growth rate is going to be using the PEG ratio or using Bloomberg EE function. There on Bloomberg, you have to highlight over it and see what the numbers are and come up with your own CAGRs there. If your firm doesn't have a PEG ratio, then you're just out of luck on that. It is possible sometimes, if Bloomberg doesn't have the data, you can go to Yahoo Finance and get the data and figure that out as well. So it is possible on the PEG ratio. The ROE is just traditional way we talk about sustainable growth. It's your ROE times your retention, how much you retained. That's your sustainable growth rate. That assumes turnover and margin are somewhat constant over time, but that's your growth. What is your actual growth rate? Where do you get that? Where do you get the numbers you actually put in here? There's only one source for that. Where is that? Your brain. Yeah, I was going to point at my brain too. Yeah, it's entirely your choice. I used to have in my investment class, I have students say, where do I get my growth rate? Yeah, there's no place that will get it. So you've got to come up with it yourself. I know some of y'all are listening to the Motorin. He talks. See, this is probably probable, possible. What was the last one? The last one's possible. Oh, plausible. Which one's less likely? So plausible, probable. So possible probably comes under your bull. I don't know what comes on bear. It's just your downside. But what he's talking about is your growth rates need to be logical. You're saying, wow, this firm's like with me with Walmart. Walmart's talking about using Chat GPT and AI to actually have people do purchases. I don't know if they're the expert in this. I don't know what kind of people they have in their IT. I don't know if it's gonna work. It seems possible. Is it probable? I think it's probable the industry's gonna use it, but is it probable that Walmart's gonna do it better than anybody else? That I gotta kind of decide, those kind of things I gotta think about. Has Walmart shown itself to be really, really advanced in technology and innovations in that area? I have to kind of think about that. But he doesn't give you the answer. The other thing he talks about is life cycles. Is this an emerging technology? Is it a maturing, or is it growth? Is it mature? Is it declining? Where are you in the life cycle? So Walmart is definitely a mature industry, mature company and a mature industry with some exciting things going on that are interesting, innovative, but they're not radical changes. Versus I'm doing NVIDIA, obviously you're in the front part of this AI revolution, very, very exciting. So here's my growth rates. I'm not gonna go on a great discussion on how I came up with them. There are some things I'm really excited about with Walmart. I'm actually really impressed. About 10 years ago, 8 years ago, people were talking about Walmart being on the decline, that Amazon was really, really putting them to shame. And then you had some of these new startups, and you had like the Home Depots and Lowe's and these specialized coming up. So it looked pretty bad for Walmart, and I think they've done an exceptional job reinventing themselves and doing some pretty exciting things. Plus, we'll talk about their economic moat, the brand name, and then most importantly, their stores and their locations. That gives them a huge advantage. So there's some innovative stuff going on in this industry. The problem you have with this industry is everybody's already using it. It's not like there's some untapped consumers out there. So for them to really grow, they're going to have to take business from other people or grow overseas. So, it's not like there's a bunch of consumers that haven't, oh, well, there's like 1 billion people in the world who aren't, and there's like 100 million people in the United States who never use retail stores. They just don't exist. Everybody's using them. There are markets out there, and the population itself is not growing that much. So it's hard for me to get too excited about them on the long term, but there are some things they're doing short term that I think are exciting. You can definitely see that in their short term growth numbers. 3 years is post COVID, so you can't say this is a COVID jump. They've had really, really good growth. Net income growth especially has been strong. Some of that's probably because of the tax law change, but pretty decent revenue growth. So they've had some growth. Someone was asking the growth of what? Oh, sorry, I gotta fix that typo, long-term growth. So what is the growth in? It's the growth in whatever your denominator is. What are you valuing? Is it dividends? Is it free cash flow? It's the growth in whatever you're valuing. And then how many years is it going to take for them to go from 8% to 4%? Here's my numbers there. If you're lost in some of these numbers, email me. I have a video I use with my investment class to go through every single one of these numbers in more detail. And if you really want that, you can do it. Someone who took my investment class, you saw that video, but I can get that to you. And so I do my valuations. So here's my valuations. So what I do with my valuations, I take the bull and the bear case, and I put them into my football chart right there. Right? I've already done all the work for you. I wasn't going to give you a video on how to build football charts. Instead, I just gave you the football chart. So I've done all the work for you. So you just type in the green numbers. Someone was asking, well, what about my base case number? I don't use it in the football chart. It can be important coming up with your target price. So keep that number and look at it. We'll see when we look at the end at the target price. So my football chart, I got the DCF model, I got the H model, and I got the 52-week range. All right, so I just got 2 models to go. Questions on the DCF model? All right, so let's look at the relative value model again. Bring in your data, you paste the values. You have the output. On the output, you may have to do a little bit of editing to make sure the last row is the latest date. You may have to copy some formulas down And then there may be more formulas down below, so if there's more formulas, but they're empty because there's no data, you might want to get rid of all of those, but you got your data in the output. Then you have the analysis and the range. I'm doing EV to sales. To be able to use the capital IQ model, you have to use either EV to sales or EV to EBITDA. Those are the only two that really work in that model. EV to sales is exactly what I want for Walmart. Now, on the Bloomberg, let me give you a trick, not just for this class, but it's really, really helpful. I gave you a selection of some companies to use. I mean, some industry to use, but you can use others. So you notice this starts with S5. That means this Standard & Poor's 500. If you just go into Bloomberg and type S5 and then try some other words related to air. So who was doing aerospace? Was that you, Aaron, or Paul? You can just type AER or whatever in Bloomberg, and it will bring up the index for your industry. If you're doing auto parts, you can just type auto. So just type a few letters and see if you can find the Standard & Poor's index. And you can actually just type that over here. So I gave you some to choose from, but I didn't put them all in there. So there are some, like aerospace, I don't think I have in here. So if you want aerospace, you'd have to do it yourself, but you can find it. So remember that S5. There probably is an index for your specific industry. You can get pretty specific. Like for passenger airlines, you might even try the word passenger. Sometimes it's not in the ticker, but it's in the description of the ticker. So when you type S5 and more words, Bloomberg will find what you're looking for. All right. So Bloomberg has a lot of very specialized tickers, and will provide PE ratios and all of that for your particular industry. Depends on how precise you want to get. I guess I could have just brought them all in, 100% of them in, but there's a few of these industries that have like one company in it. And so I thought that'd be kind of overkill to bring them all in. There's like 150 something of them. It's kind of crazy. So I brought in a few, but I probably could have brought in more. So what do you do with the analysis? Well, be real careful. So here, I'm going to give you a little bit of help here. These are not their EV to sales. This is their relative EV to sales. So remember that 0.33 means they historically have traded 67% cheap to their industry on EV to sales. So that's pretty critical to know that this is not their EV to sales. This is not the number you're going to put into capital IQ. Right now they're at 39, so they're a little bit rich to the industry. Here's the ranges. And there's your valuations at the 10 percentile. You can use a 20 percentile if you want. Why would you do that? Well, if your firm just has some crazy values, or just maybe they had 10 years where it was just ridiculous, and the 10% is just giving you some crazy numbers, and try the 20%. So here's my values there, 73 and 112. So I go back to DCF, and I just stick that into the model. So again, I've done 98% of the work for you. You just got to copy and paste the numbers over. You got to decide a few things, but any questions on the relative value model? Feeling comfortable? Right. So what else can you do? I showed, I think, Nicholas this earlier. So for the capital IQ model, you actually need their EV, EV to revenue. So I'm going to actually add it here. I'm going to bring in the median, the 10 percentile, and the 90 percentile. So go to paste values. So I'm going to do equal percentile. I'm going to go to paste values. The EV to sales for Walmart is in column C. You do that entire range, hit F4, lock it in, comma, and do the 0.5. So their EV to sales on average has been 0.73. All right, everybody see what I did there? Point 0.73. Y'all see what I'm saying? That this 0.73 is their EV to sales. This 0.33 is the median of their EV to sales divided by the EV to sales of the industry. So don't mix up the industry relative to their actual EV data. So which of these numbers goes in the capital IQ? The 73, right? Not, don't put the 0.33 in the capital IQ because that's the wrong number. It's the 0.73. All right, and then I want the range. The range was between 54 and 101. Now, you might say 101 sounds awfully high for Walmart. Remember, their net margins were in line with the industry. So it's not that unreasonable to say Walmart wouldn't trade in line with the industry. That's not completely out of the reach. I would definitely not want to see Costco being above the industry. That seems a little high, but for Walmart, it's a little high. I don't usually think of Walmart as being, a high margin company. So there's our ranges, but remember that this is for capital IQ model. And you could use this one if you want to have, so the capital IQ model, you could run your base case, high case, and low case, and use those three values for your capital IQ model. I only did the high and low case because that's what I needed for my chart, but you could run all three of those. What if you're doing EV to EBITDA? Would you do the same thing? Bring your percentiles over, do equal percentile, come over to pace values, and EV to EBITDA is in column E. Point 5. So if you're using EV to EBITDA, you would need to use column D. If you're using EV to sales, you would need to use column C, all right? Again, if you get wild numbers, you can use the 80th percentile. So you have a couple of choices here. You can change your percentile or something that might even be more interesting. Let me just show you this. You might graph your company's numbers. You can see it's come up quite a bit here recently. So they look expensive here recently. The other thing you can do is on the output, do their EV to revenue versus their industry. You can graph that as well. See the price relative because their industry is up pretty high as well. They'd still look a little expensive on EV to sales here. but not as much as you look. So obviously industry's been coming up. So you're trying to figure out if there's something unusual about this firm over time. If maybe early in their history, they had just extraordinarily high EV to sales, and you just want to take those years out. So a couple things you can do with the graphs. You might use these graphs actually in your pitch book. Walmart EV to sell versus the industry EV to sell. As you can see, they have historically traded at a pretty good discount versus their industry. Even today, when the EV to sales is high, they're still trading cheap to their industry. And they're not as a particular high or expensive, but not, it's not the worst they've ever been. So a couple of choices that you have, you can change the EV to revenue, or you can change your starting date. So if you have a chart that maybe it starts way up here, but then the last 20 years is kind of a normal range, then start your Bloomberg data where that makes more sense. Everybody understand what I'm saying there? So you just have, I've seen some of your stocks, they have like 10,000 PEs because their earnings per share or EBITDA is close to zero. It's just they're starting up, they have very little data that goes on for 4 or 5 years, and it just gives them this massive number. It messes up your chart. Just go back into Bloomberg and find another stock. Okay? So you'd have to create all of this. So y'all see how I created all of this. You do a graphic. So you can see the data itself. You got to create this. I guess I could have created all this for you, but so I guess I only did 85% of the work. So you got to do 15%. But okay. Figure out how to get some sense over time of what this looks like. And nice thing about building these charts is they would work pretty well in your pitch book. And you get into valuation, especially when you get to the end, trying to say this stock's expensive or cheap. So why would you say with Walmart based on its history? Is this an expensive stock? Looks like the whole industry is expensive, right? Because they've jumped up, but their relative hasn't, but they are expensive. And you see that here, it says they're 16% expensive. I'm using the 10%. Get all that, see if they're looking pictures of their phone, that's fine. I'll save this particular file to Canvas and just have Walmart in the title so you can see what I did. All right, so I got the data I need now for my Capital IQ data file. And I've got my relative value. So how are we doing on our charts? We only need one to go. What are you going to call this last one? So what do you want to call these? You want to call it something that sounds really sophisticated. So some creative writing. What else? What could you call DCF model that doesn't sound like a college student's doing it?
It's the sweet model.
Don't call it the sweet model. I'll get in trouble with Mr. Gordon. I don't know. Is Mr. Gordon still alive? I don't know who Gordon Growth is. So find something. H model, you probably could do a multi. Or some people call it a two-stage growth model. Relative value model. I don't know. Come up with some terms that sound pretty interesting. I couldn't think of what to put on the Capital IQ model. It is a very traditional investment banking model. You see it a lot in the investment banking world. So something sophisticated. All right, let's do the Capital IQ. If no one has questions on relative value, let me make sure I save it someplace I can find it. I like this file because it has, in just a few seconds, you've got a lot of really good data.
The alumni that's doing stuff out in Europe, he's like 21 different.
Yeah, I just emailed him. He might talk to a class the next 2 weeks. But it'll be 1:30 a.m. his time, so he's still thinking about it.
Yeah, like what other engagement does he have?
Well, he has one called capitalized earnings, I don't know if he stole that from my class. I don't use it anymore because the motor ran really bad mouthed it. I like it, but I don't know if that's the same as mine. I think he has multiple relative value ones. EV to sales, EV to EBITDA, price to earnings, multiple of those. I'm not sure. I can't remember. I'm hoping he'll show us that. He's real leery of showing it. But if I turn the cameras off, I think he'll show it to us. So hopefully he'll show us that. I specifically asked him to show that to us. But yeah, I'm really hoping he'll speak to us. I am working on speakers right now for the remainder of the semester. I may actually give y'all some Tuesdays as individual team. Make sure I see you one-on-one this week, though. If you're not making your team, I've seen about 5 of y'all so far this week. Other questions on the relative value one? I think Ben and I might do another TikTok on the relative value model. We're becoming famous. Already done 2 videos.
Are you gonna be able to get them down to TikTok link so you can post them on our?
Yeah, I can't get under 5. I might be able to do this in under 5 minutes. But we just have too much important stuff to say to get it done in 2 minutes. Is there like a rolling TikTok? It has to be 2 minutes?
under 60 seconds.
60 seconds.
No, you can, like, it's not gonna get a lot of views if it's like, except like above 5 minutes.
Yeah.
We can just put you on 8x speed.
We could speed it up to 150, but that only gets you down like to 4 minutes.
Yeah.
But we've gotten quite a few hits, so someone's looking at them.
I'm looking at them.
It was pretty funny though, because we try not, we're such horrible actors. Hey, Mr. Sweet, how are you doing? Hey, man, good to see you. But anyway, we're doing our best. All right, let me say this real quick. We're trying to go viral, and do something so crazy it goes like even non-finance people are watching it.
Like,
So maybe he'll trip next time he walks in.
wish a student should.
No, not get injured. He trips and knocks me over and I get injured. And it ends my bike streak. That would be a good.
Well.
All right. All right, let's look at the capital IQ model. So this one's working pretty well. I know it has all these competitors. This model, the way I have it set up here, doesn't really use this information over here. Nicholas and I were looking at in Bloomberg. They had a function I didn't really like before, but if you do Walmart, function 8 and SPLC, was that it?
Yeah.
SPLC. So that's their supplier or something. It used to be a function I didn't like at all. It came up and it had all the suppliers, all the customers, all the competitors, but it wasn't set up in a good way. But they completely revamped it, and it's much nicer now. I don't think y'all use that. Do you use that one, Reed? Yeah, it is much nicer. If you haven't used it in a few years, go back and try it. It's much better. So you can click on the suppliers and see who they are. You can click on the customers and get a list of the customers and the competitors as well. So Nicholas is trying to find competitors from some firms like New York Times. Who's the competitors from New York Times? It's really hard to find distinct competitors from New York Times. I didn't realize McGraw-Hill was publicly traded, and it looks like it went public like a year ago. So we found a little bit of data there. But yeah, the SPLC function is really quite good. So it will give you some competitors as well. So if we go into each one of these, so number 1, you're going to get that number straight from the discount rate in your DCF model. Everybody remember where that is? Remember in the DCF model, under discount rate, that very first number is your risk-free rate. I would recommend you pick a risk-free rate and you just stick with it. So just paste it as values and use it for all your models. You don't want one company to look better than another one just because you change your risk-free rate. So keep it consistent throughout. And then your expected market. So you might write this down. The risk-free rate comes out of the discount rate in B8. And the expected return on stocks comes out of the discount rate on B19. So this is ECF, E8 on the discount rate. So in cell H14, go find the risk-free rate, you put in the B8 on the DCFA model and the discount rate sheet. All right, everybody got that down? And then the market return. DCF. Go down to B19, that's expected return on the stock market. Got me there. On the third one, enter your size premium. There, I recommend you use the motor in. You can find him on the internet. He actually has an Excel spreadsheet that shows you size premiums, other things. I don't know if there's an official like Farmer French size premium out there. You can probably find one. You can probably just Google CAPM size premium small stocks. See what comes up. Something will come up. Or you can even type the motor in. You get the official source. Data for current year. You'll find it in there somewhere. Just look. Just search the word size. It's not there, but it's there. He has it somewhere. Rajan, do you have a size premium source? French, Farmer French. Yeah, I mean, that would be probably the most. I doubt it changes all that much over time. But anyway, it's out there. You can find it. And then Morningstar is asking what happened to it. So, but anyway, it's out there. If you have a smaller company, and they'll hopefully give you some indication of what size premium means, because it changes over time. I used to think a small company was $1 billion. Now $1 billion is almost micro cap. We came up with a new term, right, on Monday. You remember what it was? Pegasus. So we're using UTSA is starting the term Pegasus. Y'all know what a unicorn is? $1 billion startup. So what's a Pegasus? $1 trillion. $1 trillion startups. So what's the firm we're talking about? OpenAI, yeah. OpenAI is going to go IPO at $1 trillion, so we're going to call them the first Pegasus. Y'all use that term. Use it in Dr. Beckham's class, and y'all talk like it's a known term. Just get it the spread. Use it this at Thanksgiving. Y'all see OpenAI is going to be the first Pegasus stock out there, and we're going to have it spread. I didn't know if Pegasus had a unicorn. Did y'all know that? It has wings and so it doesn't make sense. So that would be a Pegasus. If the unicorn was $1 billion, then a Pegasus has a unicorn and has wings. So
Make that a TikTok.
I came
Okay.
up with it.
Make that a TikTok.
That was you who came up?
I came up with it.
Well, I was asking what it was called, so yeah, I guess you.
No, make that a TikTok.
You were like, what's more rare than unicorn? Like
Yeah.
Pegasus.
And it's more
And
colorful.
that's how it was formed. But don't talk about that. It's been around for a while.
Yeah, we're
Yeah,
gonna start.
that's a normal thing.
Yeah, I've always.
You got to talk to people in New York when you're there, and everyone just bring it up in conversation. The best way to get it to spread is you use it like everybody knows it, and then like they're stupid that they don't know it, and that's when you'll get it really take off. In fact, get 3 of you together using it, and then you all know it, and you'll get it. All right. So those are the 3 things. You might not need a size premium. Most of your firms, so like gambling.com might need a size premium. Some of you are doing a little bit smaller companies, but all right. All right. So on the debt, there was some error in this model on debt for Walmart. For some reason, it gave me a 0. So if you're getting a 0 in H21, I went to Bloomberg and used the WACC function in Bloomberg, and I got their cost of debt from there. So I just said Walmart, function 8, and WACC. If you got a number, you don't need to worry about it. But if you have a zero there and you know your firm has debt, I don't know what happened with Cap IQ with Walmart, but it just did not bring up a cost of debt at all. So I plugged in a cost of debt. 3.5 seemed right to me. I know that's lower than the treasury, but most firms borrow out 3 to 5 years, so it's not that low, and this is a AA rated firm. All right. Any questions on that? That's one I didn't have on your list. So just realize H21, if you have a zero on H21, you're not all lost. You can find a cost of debt in the white function in Greenwood. All right, and then you come down to H36. This is your betas that you're going to pull from your DCF model. Use the same betas here. Here's the one place you're going to, here's one of 3 places you're going to change your assumptions. All right. So let me type it out so you can see it. So the first place you're going to do this is in H36. You need to have your error rule scenarios. All right, so whatever betas you use in your DCF model, just bring those same ones in here, your bear and your bull. The next one is over to the right. And Q99. Betas, this is from the DCF model. Q99, your relative value from the value model. Make sure it is your company's value, not its value provided in the industry. All right, make sure you're using their actual value. That's all that stuff I built off there to the right, so you can see it. So let's see if anyone's paying attention. So for Walmart, what number would I use for my bear and bull? Or EV this revenue? All right, so it's not in your policy, you have to build it yourself. All right, so you use those two numbers, 0.54 and 1.01. There, use the 0.54. Now, if this firm hasn't been growing all that strongly, their margins are in line with the industry, so I don't feel like I need to adjust that number that much because I don't think they're that far off from where their long term is going to be. If you have a firm that has a really exaggerated number there, this is where you might want to look and see what the industry's number is. If your number is extremely high for your firm, remember this is their terminal value. So if they're trading really, really rich because they're growing really, really fast, you're probably going to have to adjust that number down. So be careful here on this number. There's some subjective, but be careful. This is the terminal value. So you might pull off some, look at industry, think what seems reasonable. If you need some help on this, talk to me. There's ways. Remember the formula I gave you on what the PE ratio equals, your payout divided by your all these different factors. There's a way we can kind of pull this back. If your firm has an unusually high number or an unusually low number, unusually low, and it's possible that their terminal is going to be higher. But usually most firms, it's either gonna be what they currently are, or it's gonna be something lower because they're in an unusually high growth period, all right? So just be careful on that. One thing you might also look at is, look at the market. I mean, it's possible for some of these stocks, you look at it and say, this industry is right now really rich to the market, but it's gonna become a normal, so maybe you're gonna find something that you're gonna come down closer to what the stock market itself is. I don't know. You just think about it. It is a terminal value, so it needs to have some credence of being the firm when it's a normal firm and not growing 30-40% a year. And that's, I mean, Nick was talking about your gambling.com, and that's gonna be an issue. It's probably gonna have a very different EV to EBITDA 10 years from now than it has today. All right. Questions on that? And then the last thing is cell L69. That's your growth in revenue. So here you can use your data. Now you might say, well, my DCF model, that's growth in dividends, that's growth in earnings, that's growth in free cash flow. But you look at the way this model is built, it uses a very constant margins on the way down, which means whatever growth rate you do on revenue essentially becomes a growth rate for everything else, because everything else is fairly constant. So they don't put much operating leverage or those kind of things in here. So as the revenue grows 4.5%, earnings grow 4.5%. You can key over each one of these. So if your firm's expected to grow really fast in the next 5 years, you can do 20%, 15, 10, 5, whatever you can get down, but that's the one you want to do some analysis on to make sure you have something that's reasonable given your forecast. All right. After that, you can change these other numbers. You can see they're essentially set to equal the previous year more than anything else, or the previous 2 years. But the model itself is set up to whatever you put in 2026, it's going to be the exact same, or 2025, depending on the company's being exactly the same in the other years. But you can edit more things in here. If you think the gross margin is going to rise over time, there's other things you can edit in here. You might have to play around with a little bit, because if you want their earnings to grow 4.5%, but you're changing some of these other factors, you may have to manipulate the revenue growth down some to get the other factors to work. So you play around with this, but this whole section in here is your forecast. You can see the titles over here on the side of what you're changing. So you put those in there. And you can see at the end what your final CAGR is. Does that formula look familiar?
That's the thing.
It's the exact same formula, right? So I didn't put that in there. Cap IQ, they probably stole it from me, but I didn't invent the CAGR. All right. And then what do? Finally, you come down, well, and then in H99, make sure your relative is multiplied by the correct factor. Revenue or EBITDA. So if you look at H99, if you go over, oops. So if you look at H99, You go over and look. Mine is multiplying by revenue. But just be careful, make sure you have which line it's multiplied by revenue. Or if it does, I know those two lines, and make sure you have the right one. Multiplied. Someone was asking about this cell right here. Why is it multiplying by that cell? All that cell is doing, it doesn't even show a number, but there's a formula. All it's doing is it's saying their fiscal year ends in March. It's October, so they're just adjusting the discount rate for that partial year. That's all they're doing there. So it's not something, nothing you need to adjust. If you accidentally hit delete there, you mess up your formula, but be careful on that. But it's not going to be that. I don't know if it has that material, but come back. And then your final answer is in H110. And there's your price, $43.26. And then you take that and you put that into your model. You run the high case, do the same thing. So make sure everybody's clear. What's your bull case on beta? Is it your highest beta or your lowest beta? Lowest beta. All right. On the relative value, your bull case is what? Your highest relative or your lowest relative?
Highest.
On growth, your bull case is what? Y'all better get this one right. Your highest growth or your lowest growth?
Highest.
Ah, my word. Miss Quinius was my typing teacher in high school. Did y'all have typing teachers in high school? No? Guess what I learned to type on?
A typewriter?
An electric typewriter. I sat next to John King, and he couldn't type at all, but he would push all the keys, and when you turn an electric typewriter on and someone's pushed all the keys, it goes wow. And Miss Quinius was like, "Oh, Ron, what's going on?" But she would be really disappointed in seeing my typing today. All right, so that's how you're running those scenarios. You just run it, you get that data, write it down, copy and paste it over, and then you go back and change your beta, change all your other assumptions, look through it. Spend some time. It's going to take, spend 30 minutes on this thing. Don't just plug in numbers and go. Look through it, make sure everything looks reasonable, as you don't have some error somewhere that you didn't forgot to change something. But you see what you got to change. There aren't not that many things that you need to actually change in this model. Most of it comes over. We're accepting certain things like the tax rate, and we're accepting the debt unless you have some error there on the debt side. But most of the stuff you bring in is, most of the stuff you change, you have from the DCF model or from the relative value model. So you have most of what you need. Do look at this model and see how it's structured, because you will see this. In fact, this is what with Johan and his firm, this is what surprises most, is how much what he was doing looked very much like this file. This was one of the key things that they had set up. So I don't know if he took it from Cap IQ or if they built it themselves. But it's his strength is having all this put together and then pulling data for private firms. So I think really it's their database was a big part of what they're doing. But something very, very similar to this, but for private firms. All right. So now I've got all the pieces. Where do you get the 52-week range? Just go to Yahoo Finance. Type in your stock and it will be right there. So there's your 52-week range. Oh, wow. All right. I must have typed the wrong thing. I don't think they got down to 0 this year. So there's your 52-week range. Now, what else could you put in a pitch book? It does make sense to show your stock price movement over time versus the S&P versus some key competitors, maybe year to date would make sense. Just to show how they perform. There are certain things you can do in the intro page. I gave you those examples on Canvas. Oh, I think I've already got Canvas open. Definitely look at those. There's no problem stealing some of those ideas. So down at the very bottom, I have these templates. Here's an Excel example. I mean, a Bloomberg example. The type of summary charts are just kind of normal to put into a pitch book. So look at some of those. Peers, indices, financials, ratings, there's certain things. Some of this may overlap with my financial analysis model where, you know, you would maybe pull in some charts. They may have a better chart, it's prettier looking. This one, this is linked to Bloomberg, so I can't actually show it to you. But that one's certainly possible to use. And then I gave you one from Capital IQ. No, not that one. Here's an example of CFI's pitch book for Amazon. They're in the color coordination throughout. You can see the kind of things that they show, so you can use that as an example of some things that you could do. Does that look familiar?
That's the football chart.
There's a good old football chart, just like you would expect. So, and then on WhatsApp, I gave y'all a few videos of people doing pitch books. Y'all remember that?
So this is all the CFI guys doing it?
No, these were some student competitions that people were doing.
The institutional investment nation of one that's gonna use.
Well, this Kappa IQ is, you'll see this function a lot where they go out 5 years with forecasts and then they multiply the 5th year by your relative and then take present value of that. That's pretty standard out model. Yeah, and then when you see Johann's model, it looks practically identical. So it's pretty common. And if you went to investment, it may not look exactly like this, but they developed this to make it look exactly like you could use, assuming that you have access to Kappa IQ. If you go on the Bloomberg machine, I could probably find a model like this. Bloomberg has an Excel library. People have already built these things, so there's plenty of out there that have been built by investment bankers that are out there on Bloomberg for free. I just didn't bring in a massive, maybe I should go out tomorrow and look for more of them, but there's probably some that we can get on Bloomberg to look almost exactly like this as well, but tied to Bloomberg. So you should steal all you want to. I mean, that's why they're out there. That's what your boss wants you to do, right? You don't need to reinvent the wheel in your first job. It's actually better, you know, does your boss wants you to reinvent the wheel or go out and use the best stuff that's already available? So if I want to do something no one's ever done before, when they're like, you know what, just do what people have done before, and then in the 3 years, you know, be creative. I mean, be creative while you're using other people's stuff because they've already thought through it, they got it built, it's already set up. Now, the last thing I did, and this you're gonna just learn this right now, just to show you how to do it. We only have 5 minutes. I like to put the current stock price in there. And so what I do is I actually type the current price, but slightly off. So the current price was 101.18. So I do 101.179 and 101.181. I then put it into the graph. I add it to the graph. As you can see that it's in there. And so that it's just a little line that gives me the current price just so I can see where it is. You'll see what I'm doing. You would have to add this yourself. So you have to right click and just change the data so it goes through row 7. And then put the current price here, but don't give it a title. You don't want the current price in there. You just want a line. So I put the current, you gotta make it a tenth of a penny off so that you actually get a little line there. And so there it is right there. And then I just draw a line, print the current price in there. And if you look at it, I would probably not recommend Walmart. I've been feeling Walmart's a little expensive. I used to think it was cheap there for the longest time, but here the last couple of years, it just seems expensive to me. You can see it's, as you would expect, my valuations are very much hitting, except for the traditional investment banking model, very much hitting on the current price and the 52-week range. There is some upside, but there's definitely some downside. Now, what most students do is they look at this and say, you know what, I don't like the traditional banking model. I'm going to go in and fix it so that it looks more reasonable. But that's not what you're supposed to do. All right. I'll just tell you, we got 1 minute here. Students get a strange price, and their first question is wrong. What's their first question?
Why do I have this price?
What did I do wrong? That's not the right question. What's the right question?
I'm a genius.
No. What does your boss want you asking? What's the most important thing you can ask?
Why is the?
Where do I disagree with the market? That is the single most important question. If you can't answer that question, you're in limbo because, wow, I think it's cheaper than the market. Why? Because your growth rate lower, is your discount rate higher? You're not going to be able to figure that out, but you need to stop and ask, where is it I disagree? That's why you can look at Bloomberg and their revenues in 4 years is forecast to be 50 billion and using 42 billion. Man, I'm way off on the revenue growth. I disagree with the market on revenue growth. I don't think they have the revenue growth here. Well, if your price is not strange. So my main thing is don't get a strange price and let me fix my assumptions. That's not correct. Because your boss wants you to create models that get you close to the current market price. No, they don't need you to do that. They already have the current market price. So you need to set up your prices, ignore, don't even look at the current market price. Do everything with looking at price and then look at the price. Don't let your first question be, what did I do wrong? Because you might be right. Now, it's possible, or do I have an error? That is possible. Who should ask this question? A college student, an entry-level employee, or a 20-year veteran? Who should ask this question?
Everyone.
Everyone, right? So that should always be a question, but don't assume you did something wrong, and don't say, let me fix my assumption, make it look like the market, because otherwise, what does your boss need you? All you're going to do is come up with models, everything looks like it's well priced. So start off with what you believe, put it down, put it into the model. If you see some weird things, then yeah, you can ask, maybe I made a mistake, I need to fix it, but maybe the market's wrong, or maybe I'm wrong in my assumptions. Maybe everything's right in your price, but you have a really bad assumption somewhere. So all those would be questions to ask. All right, so I will put the capital IQ, I'll put the capital IQ, no, what did I say? The relative value. I will put this one back out there with the Walmart in the title. I don't think you need the other things. I tell you what, I'll put the other models out there too with a different word at the end, just in case I did something you need. All right, any questions on that? This week, if you're looking at 3 stocks, you need to get 3 football charts and pick one of those stocks you're going to do your pitch with on. That's really important you do that this week. All right, everybody understand? Whoever gets their pitch books scheduled first and we decide to buy the stock, we're going to take a picture. You'll be the first stock purchased in the portfolio. No pressure, but that would be pretty insane to be the first person to do it. All right, we'll stop it there.